What's up, stock compounders? Brad here. So today I want to talk about advice for someone who's just getting started investing in the stock market. This is advice I recently heard on a Q&A session from Mohnish Pabrai at William and Mary College. Now, Mohnish Pabrai is my personal investment mentor. I think he's probably the person responsible for propelling me forward as an investor the most out of anyone on this planet. So I just want to reiterate the advice that he gave to William and Mary College. I hope it's going to be helpful for many of you. So step one, as a new investor, open a brokerage account, okay? There's very limited learnings you can have by, just trading in a paper account, right? Some fictitious account where there's not real money on the line. Buffett would say, if I had to teach two classes on investing, one would be how to value a business, okay? How to determine what a share in a stock of that business is actually worth based on the fundamentals of the business. The second class would be understanding investor psychology, okay? So such a big part of becoming a better investor is understanding your own psychology as it relates to money, as it relates to investing. And the only way to learn about that is to have real money on the line and to feel what it's like emotionally, psychologically, when the prices of your stocks are jumping up and down on the screen. Okay, this is real money on the line. So you've got to open a brokerage account. You've got to actually put money on the line. Now, what kind of brokerage account should you open? So don't open a Robinhood account, okay? That's what most youngsters are doing these days. The issue with Robinhood is that it's really the gamification of investing. And when you gamify investing, it's going to get you to do a lot, okay? Everything on the screen is promoting you to act. And as Warren Buffett says, the stock market is a tool for transferring wealth from the active to the inactive, okay? So one of our greatest edges as investors is patience. And if you're using a brokerage account, that's gamified, it's very difficult to be patient. It's really working against our greatest edge as investors. So you want to avoid Robinhood. I've used TD Ameritrade. I use Fidelity now. Interactive Brokers is good. You want something that's very boring, okay? You don't want something that's going to stimulate you and, cause you to make all of these short-term decisions. So that's the first one. Open a boring brokerage account. The second piece of advice from Mohnish Pabrai, do research into different businesses. And a great way to do that is to start with a list of businesses that you're currently giving money to, okay? What companies are you a client of right now? Are you a customer of right now? So for me, I'm recording this on an iPhone. I might look into Apple. My phone service is through Verizon, so I could look at Verizon. I pay my utility bills to Pacific Gas and Electric here in California. I shop at Amazon. I have an Audible subscription, which is owned by Amazon. So just make a list of businesses that you're currently giving money to. And those are going to tend to be very dominant, strong businesses. So it's a great way to come up with a short list. And then the other piece of advice Pabrai gives is follow a punch card investing approach. And this was also shared by Warren Buffett a number of years back, where he says most investors would do better if they had a punch card with 20 punches on it. And throughout the course of your entire investing life, all you could do is buy 20 stocks, okay? If that were the case, it would force you to think long and hard before buying or selling a stock. And Buffett thinks you're likely to do much better if you take that approach, where you're really limited in how many swings you can take at the plate as an investor. So right? Start with businesses that you use and, follow the framework. I'm only going to buy 20 companies in my lifetime. So obviously that's going to narrow it down. You're only going to want to buy in businesses, invest in businesses that you think you're going to own for 10 or 20 or more years, okay? And that's really where the magic of compounding happens. When you buy a business that is generating high returns on capital, and you can just leave your money with that incredible business, with that incredible management team, and let the business compound your money over time, rather than relying on your own, savviness to shift money around every year or every couple of years. Just ride those incredible horses off into the sunset of compounding. So that's number 2. And the last one is actually buy a stock. Okay, Pabrai says, obviously you're not going to want to buy 10 stocks right away if you're following a punch card approach, because then you only have 10 left over the next 70 years or however many years you have as an investor. So pick 1 or 2, maybe even 3 stocks to get started, okay? And when you're looking at these companies, try to find opportunities, businesses, where you think you're going to own it for a decade or more. The financials of the business are really compelling, right? The returns on invested capital for those businesses are high. You think they're going to continue to be high because the business has opportunities to reinvest those earnings over time and really keep that compound growth going. And I would also encourage you to think about the price. A great business isn't necessarily a great investment. It's got to be able to be purchased at a compelling price. So we don't want to pay any price for a business. If you look at Microsoft during, the dot-com bubble, you could have bought Microsoft in the year 2000, and it would have taken 15 years before the price got back to where it was in the year 2000. Obviously, Microsoft is a great business. Okay, nobody would question that. But clearly, you couldn't have bought Microsoft at any price. Who's going to have held on to Microsoft in the red for 15 years before it got back to break even? So you want to consider the price. I like how Terry Smith of Fundsmith in the UK thinks about valuation of businesses. He really pays attention to free cash flow yield, which is just free cash flow over the course of a year divided by the market cap of a company. Market cap is just number of shares outstanding times the current share price. So, those are some things to think about. Price to earnings is a valuation metric that a lot of investors use. I just watched a talk by Guy Spear with the Kolkata Value Investors Club. He thinks, price to earnings is probably outdated in terms of, where he's seeing great growth opportunities. There's this whole universe of companies that are kind of old economy companies where he thinks more and more of those are going to be value traps. Okay, they appear cheap on paper. Price to earnings, price to free cash flow, price to book kind of metrics. But he thinks the new economy, software, these growth industries, right, artificial intelligence, are really going to chew in to those old growth industries and make it very hard to do well as an investor, even if it looks like we're buying cheap on some of these different metrics. So keep that in mind. You don't want to pay any price for a great business. And, where those opportunities are becoming available is shifting. Okay, as investors, it's really a game of continuous learning. We can't rest on our laurels. Guy Spear was lamenting a little bit how he's spent the last 20 years really learning how to identify these great businesses, these cheap businesses on paper, right, in the financial statements. And a lot of that, has kind of gone out the window. He can't really use those metrics anymore for finding compelling investment opportunities. So it is, especially as technology accelerates in our current age. We've really got to be continuous learners. But pick 1, 2, 3 stocks that you're currently a customer of, businesses that you're a customer of, and let the learning begin. Pabrai would say, you don't really understand a business until after you own it. So it's really important to put actual money on the line, and obviously not too much, but enough that it matters. It matters how the company does. It matters these gyrations in price. It's going to impact you. That's where the real learning is going to come in terms of understanding who you are as an investor and where your vulnerabilities might be in terms of psychology and emotion, and learning how to put systems in place so you don't defeat yourself, so you're not your own worst enemy in this game of investing. Because in order to reach the finish line, in order to achieve financial freedom or whatever your investing goals are, we've got to stay in the game. Okay, if we lose all the money, if we go bankrupt, you can't get to the promised land. So let the learning begin. So hopefully that helps, guys. I found it insightful, these sort of pieces of advice from Mohnish Pabrai, and hope it's helpful for you. Okay, I will see you guys in the next video. Take care.